We're at record highs. What's taken this, or what sustained this party, is liquidity. The FIs were buying earlier, now it's domestic mutual funds. But central banks from Europe and the United States will soon be turning the tap off next year. Interest rates are on the way up, and central banks are preparing to unwind their balance sheet. What does this mean for global markets, especially emerging markets that have benefited from the flood of fund flows? Chris Anstey of Bloomberg News has done this analysis. He joins us from our studios in Tokyo. Chris, thank you so much indeed for joining us. As I was mentioning, central banks will soon be turning off the easy money tap early next year. What are the challenges during this transition period?
Well, Harsha, we're really at an inflection point here for the developed nation central banks. You think back to 2007 when they started this massive rollout of liquidity. It was in August of 2007. I actually was a U.S. economy editor in Washington when the ECB kicked things off and injected unlimited liquidity into markets. I actually woke up the New York Fed spokesman that morning to ask him, what's the Fed going to do? And of course, in the ensuing decade, we saw the Fed, the ECB, Bank of Japan, Bank of England as well, inject massive liquidity, more than $14 trillion balance sheet cumulative as of now, if you look at the Fed, the ECB, and Bank of Japan. And next year, if you look at the Fed is already shrinking its balance sheet, the ECB is essentially phasing out its QE probably by September of next year. The Bank of Japan has been stealthily tapering its asset purchases. This is going to have a significant challenge for markets. If you think about looking at how much linkage there has been between, for example, Fed liquidity and the U.S. stock market gains. If you actually run the numbers from 2008 to 2015, more than half of the gains in the S&P 500 index came on the days that the Fed announced its policy decisions. That's how tight the linkage is. And as you point out, for emerging markets, what this has meant is massive compression of bond yields globally, which has allowed enormous investments that couldn't have otherwise been made in emerging markets because borrowing costs have come down so much. So what's going to happen to markets? Well, they face a big test when that liquidity withdrawal comes. What people are saying is that a key ingredient is going to be, how does inflation look? If inflation is still tame, that's going to help hold down bond yields and prevent what would otherwise be perhaps a destabilizing jump.
Chris, if I can just ask you one follow-up question. History has told us that any transition period of this nature is fraught with risk. What are investors saying is about the potential risks of this transition period?
Well, if you look at, most investors are saying that we've still got a few more months to run yet before this contraction begins. So now is a good time in the minds of some to start taking a little bit out of the markets. You look at, for example, AMP from Australia. They're boosting their cash allocations so that they're ready when they see a decline in bond and stock prices globally. As long as the fundamentals stay pretty solid, there should be opportunities once prices start retreating a little bit to go back in. But there's some time yet to reposition for what's likely to be the biggest challenge to global markets in some years.
Good talking to you, Chris Anstey. Thank you so much for joining us. Chris Anstey joining us from our studios in Tokyo, Harsha, talking about the easy money policy that's going to be, the tap is going to be turned off early next year. Let's wait to see how central banks react and what does that mean for global financial markets.